Nearly a fifth of the S&P 500 are set to report earnings this week, including Netflix and Tesla. Let's get some thoughts on what to expect from Ryan Detrick, Chief Market Strategist at the Carson Group. Ryan, thanks very much for joining us.
Roger, thank you. I don't think we ever got to talk, so nice to meet you, and thanks for having me back on the show. Appreciate it.
And we're coming in a busy week, starting up. Always a pleasure to talk about earnings seasons when it's looking pretty good. I think so far it seems like it's been a fairly good start. What can we expect from this week, though?
Yeah, you're right. You know, more than 80% of companies in the U.S. here on the S&P 500 have beat on earnings estimates and on revenue. That's solid. It is early. I mean, as I know you guys have talked a lot about, the big banks came in really strong. We had some worries about some regional banks. Well, we're watching this week. Some of those regional banks that were in trouble last week with some loans and some fraud and different things are actually reporting in the next couple of days. Anxious to see what they have to say. But the truth, again, it's I think S&P 500 earnings expected to be up about 8.5% when all is said and done in the third quarter. And we wouldn't be surprised at all if, once again, earnings come in better than expected. It's very early, but so far, Roger, it has been pretty solid across the board.
And with some of the big names coming in this week, what will be good numbers and what might be numbers that might give people a reason to pause?
Great point there, because again, what we actually saw the last, we'll call it 6 or 7 weeks, actually a lot of companies increased earnings guidance already. Now, normally the way the game is played, you kind of analysts lower guidance a little bit, companies lower guidance a little bit, and then you actually step up to the altar and do better. So the bar is a little higher, I guess, is what I'm trying to say here. But the reality, again, we know the Mag 7, we know technology is such an important part of U.S. growth in the U.S. stock market. A lot of those names are going to be reporting, and what we want to see, how is the consumer? How are now everyone's talking about cockroaches and loans and credit and private equity? How are those areas of lending potentially doing as well? And also, as always, put a bow on this, what is the forward guidance? Is forward guidance strong or not? Those are the things we always watch, and even more so now with everything going on in the credit markets right now, or at least private equity markets, I should say.
And everybody has their eyes on the Mag 7, but where else should we be looking?
Listen, financials have already happened. I mean, financials are such an important group, and it's so split down the middle, where the large cap banks have done well, but then you've got areas like insurance have been weak, private equity has been weak, regional banks have been in trouble. And then at the end of the day, the tech is important. Communication services, obviously important. I think consumer discretionary is another one, though, right? If people are out there going on airplay, we had some of the big airlines already actually did okay, but are people going to hotels? Are people traveling? Are people still spending money? Is the consumer still there are cracks in the consumer. There's no question about it. We don't get a lot of data in the U.S. anymore because the government is shut down, but we know the labor market is slowing. So those are some things we're anxiously kind of awaiting here as we get some big earnings from big companies.
Would that be, which ones will you be keeping an eye on when it comes to that?
Yeah, a lot of the retailers, I'm somewhat limited in terms of specifics. I have to talk broadly based, if you know what I mean. But the big retail names, I think, are the ones that we want to see what they have to say about the consumers. And honestly, a lot of these, I know I've said it already. I mean, a lot of the big banks reported, but a lot of the regional banks, right? A lot of the regional banks are going to be reporting over the next week or so. That's an area that, with all of the two big auto companies that went under in the United States, actually back in September, they went bankrupt. But now all of a sudden we're realizing a lot of larger banks were impacted by that, and some of the smaller banks, Zion specifically, took a $50 billion loan loss just last week, and their stock was hit 13% last Thursday. Those are the things I think that we didn't expect we'd be watching as closely, but the regional banks are an area that I'm not calling it the first domino. We don't think it's the first domino, but if there is a first domino to fall, maybe those regional banks are it, and we'll get a lot more information going forward.
Could that drive people maybe look at taking some profits? If those banks struggle a little bit?
Yeah, it very well could. I mean, the XLF financials, it was flat last week. I mean, virtually every other group was higher, again, because of some of the worries that we just talked about. And just from, kind of where we are, right? I mean, we just had a 36% rally in 6 months in the S&P 500. The S&P is up 5 months in a row. We're down a little bit. Maybe after today's bounce might be positive, but let's just call it flat, close enough for government work. We're virtually flat here. The second half of October can be volatile. I wouldn't be surprised at all, Roger, if we saw some relative weakness, I think that actually be a welcome sign. I think it'd be an opportunity for investors to kind of add. It came out that only 22% of active fund managers are outperforming the market year to date, like the lowest level in 25 years. There's still a lot of kindling there. I think any pullbacks will be modest, and investors will buy it up, and we'll still have a pretty good end of year rally here in the U.S. But I think a little weakness maybe the next week or two, I'd welcome it, to be honest.
And traditionally, Q4 is the strongest one, and you feel it's shaping up to be another good one.
We sure do. Historically, Q4, the U.S. is up, S&P 500 is up like 80% of the time. But when you're up 10% for the year going into the fourth quarter's been higher 14 of the last 15 times. And one more. When you hit an all-time high in September, like we did this year, the fourth quarter has been higher 20 out of 22 times. We have a dovish Fed. We have an economy that is, in our opinion, still growing, probably going to do a little bit better than people think. We're going to get a lot of information on earnings season. But I guess what brought us to the dance is still in play, in our opinion, and maybe some October spookiness or choppiness is perfectly normal for an eventual strong November and December. It's how we see it playing out.
And we're almost out of time, but do you feel people may start looking outside the U.S. for some deals as well?
I hope so, because we have been. I think they should be by now. I mean, we earlier this year we actually went overweight developed international. We're an RIA with about $50 billion. We have a good amount of international exposure. I know we're near the end. Could put a bow on this. It's not just a U.S. story anymore, right? The U.S. is actually what's it up 13% on the year. One of the weakest performers so far this year. There's a lot of opportunity for investors to have a diversified portfolio, and that's how we've been looking at it. We're still overweight equities, but we have a good amount of developed international in there as well, along with, of course, some a good amount of U.S. exposure. We just think there are opportunities around the globe. Stay diversified in this environment.
Okay, Ryan, thanks very much for joining us.
Thank you.
Ryan Detrick is Chief Market Strategist at Carson Group.